Thanks, Paul. Appreciate the opportunity to present today, and thank you everyone that is in attendance. So I look forward to talking you through what have been a pretty solid set of results for Prime over the last 12 months as it relates obviously to FY23. So we might jump into the first slide if we can, please. Next slide. Thank you very much. Okay, so just as Paul mentioned, we are an advice, capital and asset management group. We currently look after approximately $1.1 billion for clients. We have around 150 team members that are dotted as per on the screen throughout Australia, New Zealand, the US, and we also have representation in Europe as well. So we're a bit more of a global footprint than we did 12 months ago as our business has grown and we've grown with our clients. The 4 service lines that we do have are, as Paul suggested, and we have now been in business for 25 years. So how we think about our business ultimately, though, is about a business that we think there are uncapped opportunities out there, and we think that we've got some great clients, whether they're clients that we're backing in terms of their business and helping to give them advice to grow their business, or investors that want access to some key themes that we're involved with as well. Next slide, please. So really pleased to report that back in FY22, we suggested that we could double our revenue from $26 million to $50 million by FY25. And we're well and truly on track, having reported $34 million of revenue in FY23. But I think equally as importantly, we are very keen to see our revenue grow again and double again from $50 million to $100 million within 3 to 5 years of FY25. So very pleased to report that all parts of our business are growing organically, whether it's the wealth, the capital, the accounting, or our SMSF business. They're all growing organically, which has been an important part of our strategy over the last 4 to 5 years. And we've also been able to roll out some new services over the course of the last probably 6 months. That includes debt capital advisory, ESG consulting, and we've also expanded our wholesale investor offering as well. One other key point to make is that we have also made our first acquisition in the last 6 years. We acquired an SMSF administration business, which we've got very high hopes for, and is actually delivering some great results, having been integrated now for pretty much 9 months of the financial year. Next slide, please. So here's some key financial highlights and why we feel that we are delivering to our plan. Our revenue is up 28% for FY23, so 19% of that was organic and 9% by the acquisition I just mentioned. Underlying EBITDA was up 11%. Our EBITDA margin was 26%. EPS up 15% to 2.22 cents per share, and our dividend up again by 36%. Our debt is about 1.1 times underlying EBITDA, which is pretty much within the range that we were targeting. So overall, a great set of results. There's pretty much not a metric there that we haven't been able to hit per our guidance. Next slide, please. Next one, please. So what we're trying to demonstrate here is since we repositioned our business about 5 or 6 years ago, we've been very focused on building the Prime brand, the group of services that we're able to offer to our clients across the areas that I've mentioned. But these are the 5 key metrics that we look at, whether it's underlying EBITDA, after-tax earnings, EPS, dividend per share, or our share price improvement. When you look at the last 5 years, we've got between a 20% and a 39% compound annual growth rate on those metrics. So we feel that the strategy we put in place approximately 5 or 6 years ago is well and truly starting to pay off, and we're very confident that we can continue to grow our revenue to 50 million by FY25, and then on to 100 million by between FY28 and 30. Next slide, please. So just breaking down some of the detail in a little bit more information here. As I mentioned, revenue up 28%. The split between organic and inorganic is listed there. However, our margin did reduce slightly. Our margin was around about 30% previously. It's currently at 26%. The main reason for that is because we have invested in new service lines. And it is important to note that that's been one of the key reasons that we've grown the business over the last 4 to 5 years, is to continue to reinvest in new service lines. And we've probably made the most significant investment in new service lines in the last 6 months that we have for probably 2 or 3 years. So we expect to see that start to improve and drive our earnings as well over the course of the next few years. So as I said, underlying EBITDA up 11%, the 5th consecutive year, which I think was an impressive result by the team. Next slide, please. Here we're just showing that in terms of our revenue growth, it has been accelerating over the last 3 to 4 years. Importantly, 80% of our revenue is recurring in nature, which allows us to make some longer term decisions and continue to invest in our business and grow it. And as I said there on the left-hand side, we do expect to see that revenue acceleration continue. Next slide, please. Now, this is breaking down to a little bit more detail, the 4 key service lines that we've got and how they have performed over the last 4 years. So a wealth management division, it's advice, it's asset management for clients. That grew by 15% over FY22. Our capital and corporate advisory division, which is equity capital, it's debt capital, it's valuations for businesses, it's ESG consulting. That grew by an impressive 42% since FY22. Our accounting and business advisory division, which is tax compliance, R&D grants for clients as well, virtual CFO and business advisory, that grew by 14%. Again, you can see the shape of that graph there. It's been very consistent over the last 4 years. And our SMSF division, which is the smallest division, but catching up pretty quickly, actually grew by 102% over that 12-month period of time. So again, there's really not a metric there that isn't heading in the right direction, which we're very pleased for. And importantly, how we go about growing our business is listed there on the right-hand side. So it's organically from those service lines. It's finding people that have existing client bases that want to join us and own part of the business that they're helping to co-create. And I'll talk about our ownership model towards the end. It's rolling out new service lines. As an example, neither the capital or the SMSF division existed 5 or 6 years ago. They now respectively print from startup between sort of $5.5 and $6.2 million. And then acquisitions, which will be complementary to our strategy and will feature more in the future. Next slide, please. What you're seeing here is just a representation of the growth in our underlying EBITDA and what the margin has done over the last 4 years. Importantly here, we make the clear statement that as we invest in those new service capabilities, whether it's debt capital advisory or ESG or building out our wholesale investor service, we've invested around about $500,000 in the second half of FY23, and it takes 6 to 9 months before those investments make a positive contribution to earnings. So we've got a pretty decent formula now that we work to, but we clearly monitor that as part of our growth strategy. When you look at the margin, as I said before, that has been slightly lower. That's because we now have the full cost of the acquisition of that SMSF B2B business that we acquired. That's now got a run rate of $3 million annually as at June of 23. And our team headcount has increased. It's actually doubled over the last, increased by 50% over the last 2 years. And we have made some investments in IT so that we can scale and obviously have a secure platform as well. But overall, everything is heading in the right direction. We expect our margins to continue to improve from here. Next slide, please. Nothing terribly compelling to cover off here other than to simply say we are well funded. We have up to $10 million that we can spend on future acquisitions without stretching the balance sheet too far. And our net operating cash flow is down slightly, mainly because of additional tax, some interest costs, and we actually have a little bit more tied up in work in progress than what we previously did. But we want to get on top of that over the course of the next 6 to 12 months so that we improve our operating cash flow and continue to invest in the business. Next slide, please. Importantly, a key metric that we look at for our shareholders is our dividends. We pay out around about 68% of our after-tax earnings, and you'll see there that that's continuously increased over the last 3 to 4 years. We do aim to pay out between 50 to 70% of our earnings, and we do expect it to have continuous improvement in that payout over time. So we like the shape of that. We think that's heading in the right direction. Next slide, please. Let's just quickly touch on the business strategy and the outlook. So this is how we go about growing the business and how we've been able to succeed in the last 5 years. Top line growth. So we're going to continue to grow from an organic point of view. That includes the existing service lines, new service lines, delivering more of our group services to the existing customer base, and identifying also new and emerging opportunities whilst having stable recurring income from not only our accounting and our advice business, but also the wealth and asset management. We'll continue to expand our margin because we drive efficiencies by virtue of having a shared services and centralised model. That means that the whole of the business leverages off that. We'll also continue to identify higher EBITDA margin services that will roll out, and we'll get more economies of scale as the business continues to grow. We do have that balance sheet strength, which we will use to enable acquisitions that are accretive and complementary to the organic strategy that we have in place. Next slide, please. Importantly, we're not just about making sure that we have great financial outcomes, but a commitment to the impact that we have. So we have an ESG strategy. Not only do we offer ESG services and consulting to other businesses, but we have our own ESG strategy internally. We have 4 United Nations SDGs that we focus on: gender equality, industry innovation, climate action, and partnership for goals. And we're pleased to say from a gender equality point of view, we now have 55% of our team are female, 46% are female in the leadership roles that we have. And we're also making great inroads around the climate action component and the impact that we have there. And on the final point there, partnerships for the goals, Prime actually started as a partnership model where, as a wealth business, we worked with accountants to help them build another service line for their clients. So partnership is in our DNA and a core part about how we think about the future. Next slide, please. I mentioned before our commitment to ownership. How we tend to differentiate and attract some of the best talent in the industry is that we have a co-ownership model in our business. Every team member that has been with Prime for 12 months, whether they are a graduate or they're someone that is in a senior position, they start to earn equity in the business on the basis of the same metrics that I get measured on and the leadership generally gets measured on. I'm pleased to say that 45% of our company is owned by the team, and this is something that has allowed us to get the best talent on offer and will allow us to continue to grow. So we're very vested in making sure that we have a commitment to ownership for the team and a true co-investment model with external shareholders. Next slide, please. So we're just going to round out here. So this is the outlook for FY24. We will continue to deliver results, strong organic growth in all the areas I mentioned before, whether it's an existing service line, new ones, or more services for our existing customer base, delivering accretive acquisitions, just like the Intello transaction in the SMSF space, which is highly complementary to our future growth. We'll continue to scale the business. We clearly don't want to be a business that's just 50 mil market cap, but we want to grow our earnings, our revenue, and the geographic locations that we are located. We want to do it efficiently by continuing to invest in our infrastructure through the centralized services model. And finally, in terms of driving growth, revenue, earnings, and dividends, we expect to see revenue up 15 to 20% for FY24, EBITDA up between 10 and 15%, and dividends up 5 to 10%. So overall, we're very confident about the future and where the business is positioned, and look forward to continuing that positive trajectory that we've had for the last 5 years. That's it from me, Paul. Over to you.
Thanks, Simon. Quite a few questions. You kind of answered this one at the end, but obviously your recent FY23 results obviously indicate a very strong performance, particularly at the revenue line. And how confident are you that you can maintain this sort of momentum?
Yeah, so I think the 3 or 4 years ago, just prior or just post repositioning the business as one firm, one brand, a whole group of services, it was harder to drive that organic growth. But since we've had all of that consolidated under the one roof in those key locations that you mentioned that we operate, it's become easier. And it's easier because we feel like we've got a lot more control over our own destiny. So we have a high degree of confidence that we've taken organic growth from being 4% to 18%, now 19%. We think we've got the right levers in place. We've got a growing client base that we can deliver those services to. And I think we're getting increasingly more cross-delivery of services within the firm. We call it our one connected model. And it's where we try to differentiate. So when the customer comes to us, they are surrounded by more services than they can get elsewhere. So I think the confidence in the organic growth is there. I think it will be complemented by acquisitions. We, as you'd expect, we have a number of conversations going on at any point in time. But we think the acquisitions will be complementary and allow us to also drive future organic growth off the back of some of those acquisitions.
And just remind us, what was the biggest contributor to growth across the various business lines?
Yeah, so depending on whether you talk about it from a percentage point of view or whether it's from a dollars perspective, we saw a big jump on that SMSF side of things, 102% increase aided by the acquisition of Intello, that B2B SMSF admin business. That was substantial. You've also got, when you look across the business, 14 and 15% growth and also 42%. But in terms of dollars, it would either be the SMSF or the capital division that's had the greatest dollar contribution in terms of revenue.
And are there any new business lines in the pipeline that you're working on?
Yeah, so we probably safe to say we're consistently looking at it, but what we don't tend to do is we won't roll something out unless we feel it can generate $5 million of revenue within 3 to 5 years. So there's a pretty strong business case and discipline that we roll through there. In fact, in FY23, that was actually our biggest year of new service offerings that we had rolled out. So our focus in this FY24 year is to really scale those offerings and make sure that we get maximum penetration for them within the audience that we're seeking to speak with. So probably not a huge degree of new services that are coming through, but definitely look out for potential acquisitions and the scaling of those ESG, debt capital advisory, and that wholesale investor service that we've been building up as well.
Just a couple to finish off. Question here: what do you do about research to support your advice activities?
Yeah, so if you're talking about research as it relates to giving our clients investment advice in the wealth division, we clearly have various fund managers and organisations that we work with that provide consulting services to us where we don't have the in-house capability. Our goal from a wealth management point of view is to manage the client's overall portfolio. That means that you're allocating out to various other fund managers, etc. Where we're tending to focus more of our own attention internally and building our capability is around the alternative space and also in the property piece as well. So I feel like we've got great internal capability and growing capability around that. But we have various other consultants that we work with that support our research functions and allows us to provide a complete service for our clients.
Right. And look, it'd be rude not to finish on a question about the board's policy on dividend payout going forward. You had a slide earlier, but can you talk a little bit about how you see that paying out in the next year or so?
Yeah, absolutely. We expect to see dividends continue to increase. That's the momentum we've had for the last 3 to 4 years. We pay out 50 to 70% of our earnings, and we expect that to continue. So we're trying to get a healthy balance between retaining what we can for future growth and acquisition, and also making sure the dividends are paid on a regular and frequent basis for our shareholders. So it's a mainstay in terms of our strategy. We expect to see it increase.
Fantastic. Simon, been an absolute pleasure. Thanks for the presentation today and have a great weekend.
Thanks a lot, Paul. Appreciate it.